Okay, let's run through a couple of examples on the calculations. If you got it in the first lecture where we talked about the theory, that's great. If not, let's give it another go and see if these make sense to you. Like before, if you have a calculator and a piece of paper and a pencil so you can follow along and do the calculations with me, that will be great. And feel free to stop the lecture at any point just to make sure that you keep caught up. As a review, we're going to take a look at the calculation process. It's pretty simple. We take the benefits, we subtract the costs, and come out with a net cash flow. We apply the discount rate and calculate the discounted cash flow. The discounted cash flow is the same thing as the present value of the benefit. We take that present value of the benefit, divide by the initial investment to come up with the return on investment. Again, the return on investment is probably the most important number in business. It's a number which many decision makers look at for projects and to decide whether or not those projects are worth the time and the effort. So let's take it through step by step. Here is a summary cash flow statement, and as you can see, it's one that you've seen before. We take the summary of the benefits and the expenses and net those out to come up with net operating inflow or outflow. Please note that inflows are noted as positive numbers, so benefits are inflow, so those are positive. Outflows are noted as negative numbers. Expenses are outflows, so they are all expressed as negative numbers. And then when we net these out, you can see it's either positive or negative depending on whether or not your total expenses exceed your benefits. We then separate assets, largely because they're treated from an accounting purposes differently, but for our purposes they're really just costs, and we're not going to go into the depreciation or tax effects of the cash flow statement. So if we subtract out the assets, we come up with a net cash flow. And that net cash flow is the starting point for determining the discounted cash flow, which takes into account the time value of money. Remember when I said before, when we just simply did this statement, you simply can't total these all up and actually have that mean anything. So even though there's a total over here, it really doesn't mean a whole lot because we haven't taken into account the time value of money. So let's do this. What we're going to do is we're going to first calculate the discounted cash flow, and we're going to start with this complicated looking formula here, but we're going to break that down into its component parts. We're going to first assume that our weighted average cost of capital is 14%. That is risk adjusted, and therefore that will be our discount rate. We'll use that discount rate to calculate the discounted cash flow for each year. So in year one, discounted cash flow is 500 divided by 1 plus the discount rate of 14% raised to the first power, which equals $439,000 in this case. Note the subscript on the discounted cash flow equals the superscript or the power on the factor that determines the discount rate here. So make sure that when you're looking at the discounted cash flow for year one, you're raising it to the power of year one. When you're looking at year two, you're raising it to the power of year two, etc. I don't really have to have this one here because the first power is really nothing at all, but for the sake of consistency, I've added that. Similarly, we're going to do that same calculation for year two. Here we take the 1,250, divide it by 1 plus the discount rate, come up with $962,000. For year three, we do the same thing. We take the discounted cash flow of $1,750,000, divide it by 1 plus the discount rate, raise to the third power, and come up with an amount of $1,181,000. Discounted year four, you can probably see a pattern here. We take the 2250, divide it by 1 plus the discount raised to the fourth power, and that comes up to 1332. And then finally, we will take the last year, the 2750, divide it by 1 plus the discount rate raised to the fifth power, and come up to 1428. And you can see here the power of the time value of money where the numbers are significantly lower in the out years. And then what we do is we sum these numbers up. And by summing them up, we come up with a present value of the benefit, or the discounted cash flow, of a total of $5,342,000. Okay, so that takes care of the discounted cash flow calculation. Let's move on and take a look at the other calculations. Well, now what we're going to do is we're going to take this cash flow summary statement, and we've added the discounted cash flow for each year and come up with a total discounted cash flow of $5,342,000 for our strategic initiative. And now what we're going to do is we're going to calculate the net present value. Net present value is simply that discounted cash flow right here, and from that we subtract the initial investment, which in this case is $3 million. So that formula looks just like this, fairly simple and straightforward, and so our net present value is $2,342,000. That takes care of our net present value calculation. Next up, let's take a look at the return on investment. Here we take that discounted cash flow and divide it by the initial investment, and we'll express that resulting number as a percentage, which will demonstrate the return on investment. Again, fairly simple formula. Take the $5,342,000 divided by the $3 million, and we have a return on investment of 178%. Pretty darn good. In fact, that demonstrates that not only did we get a full return of our money for the life of the project, but we earned an additional 78% on top of that. So we would do a project like this all day long. So that takes care of return on investment. Now we're going to take a look at payback. The payback formula, again, is fairly straightforward. We take a look at the initial investment and we divide that by the average discounted cash flow per year. And that's what discounted cash flow divided by N is. So here's how the formula works out. First, we take the discounted cash flow of $5,342,000 and divide it by 5. And that results in a number of $1,068,000. And we divide that number into the initial investment of $3 million. And that gives us a payback of 2.8 years. But wait a minute. We know one of the dangers of the payback calculation is that it gives you the wrong answer if, in fact, you have an uneven discounted cash flow stream. And that's exactly what we have. We have, in fact, an escalating cash flow stream. So our payback number of 2.8 years is suspect. And if I eyeball it, I can tell that I certainly don't pay back the initial $3 million of investment in 2 years and even 3 years. In fact, that number comes up to $2,582,000. We're about $418,000 short of paying back the initial $3 million investment in 3 years. So the payback is at least 3 years, if not a little bit longer. And so what that does mean is that payback of 2.8 years is absolutely not correct. And so we have to come up with what the correct payback is. And how do we do that? So what we know is it's at least 3 years, so 1, 2, 3, plus whatever proportion $418,000 is of the year 4 cash flow of $1,332,000, and that works out to be a formula like this. So we take the 3 years, and then we divide the $418,000 by the $1,332,000 of cash flow in year 4, and come up with a payback period of 3.3 years. So 418,000 divided by $1,332,000 is in fact 0.3. Simple addition, 3 plus 0.3, clearly different than the 2.8 years that the payback formula gave us. So once again, we were betrayed by the simple math of the payback formula, which we cannot use when the cash flow stream escalates over a course of time, or if it's in any way different year over year. So there you go. There's an example of how to step through the calculations. We'll take the time in our next lesson to actually show you how to set all this up in an Excel spreadsheet.